All right, welcome to the MI Report webinar. This one is for the MI Report we published yesterday on February 18th. I'm George Morrison. I'm going to host this session today. We're going to kick it off here with Tori Alden. He's going to take us into the biofuels section, and we'll be sharing out here shortly. Tori, can you see that screen okay?
Yep.
All right, let's have you go ahead and kick us off.
Okay, so this week we think that the EPA will publish their moderated transaction system data, more commonly known as EMTS data, that details RIN generation in January. And I just am going to run through a quick summary of what we're expecting from the report. So on the forward RIN generation, we're forecasting generation of just over 177 million gallons, which would be an increase of just over 8 million gallons from last year. D5, we're expecting 9.1, just under 9.2 million gallons. That's 1.8 million gallons above where we were last year. And on D6, we are expecting 1.33 billion gallons, which would be 125 million gallons above last year. Break it down in just a little bit more detail on the various renewable diesel and biomass-based diesel categories. For renewable diesel, we think that total renewable diesel RIN generation is going to total 82 million gallons, which is an increase from just under 64 million gallons last year. Domestic supply, we're forecasting at 40.8 million gallons, which is up from 36.5 million gallons last year. And then on the biomass-based diesel side, we're forecasting biomass-based diesel supplies at 117.8 million gallons, which is down just a little bit from 119.5 million gallons last year, as that part of the industry continues to ramp up from the restoration of the blender's tax credit earlier this year. And then domestic biodiesel, we're projecting 108.9 million gallons, which is a little increase from 107.6 million last year. And with that, I'll send it back to you, George.
All right, and I also want to mention that we're having some technical challenges with the MI report this week, so if you're unable to get into it, I apologize for that. Please bear with us, and we'll get the technical challenges figured out. With that, we'll go to John Cusick. John, would you like to take us into the RINs?
Yeah, absolutely. And I think that's timely on the more fundamental driven information that Tori just shared on the numbers. Somewhat unfortunately for the RIN market, we've had a little bit of emotional market insert this past week with some SRE news really driving the whole RIN complex northward. We thought from the overall supply demand, we've been, especially on the D4, structurally bullish about the pricing, but obviously these type of sort of EPA RFS2 driven, what we've described in past moments as being somewhat emotionally driven, certainly seems to be driving that D6 RIN, putting upward pressure on the D4 RIN, and really appearing as the main driver in this past week. I don't think that shifts wildly our view. We're going to stick to the numbers and the data as Tori took us through. We're going to continue to hold our view on how EMTS is going to come in. And so therefore, we think sort of the emotional spike out of the D6, if we see the D4 follow that in the coming days, we may see some retraction from that, like we may see from the D6. What tends to happen in the RIN complex when these sort of emotional 15-second media sound bites hit this market is that a lot of traders, periphery players try to really capitalize on these sort of moments. And so what we've seen in the past is a lot of sort of quick up-down moves. But thus far, it's been mainly on the D6 that's really been driven across this past week, less so on the D4. And we're going to stick with our forecasts and the numbers as Tori laid them out, driven by the fundamentals, and think that that this sort of emotional burst might just be a short-lived one, and the market will return back to more stronger fundamentals. In general, though, we're seeing, just to kind of step away from the RINs and touch on the biofuels a little bit, we continue to see super constructive, what I would call sort of RIN generation strategies coming out of the major refiners, and the obligated parties to the RFS2, and many of whom are regulated parties under programs like LCFS in California. And so that continues to hit headline news. This past week, we had BP announcing a carbon neutral business by 2050. So 30 years out, these are big announcements coming from the largest global petroleum refiners. And what we do know is that the near-term solutions for all of these guys in pivoting towards low carbon fuels are going to be buying the feedstocks we focus on here. And so back to the RIN markets, I think these are all super constructive, and what we're increasingly seeing is refiners coming in to figure out ways how to generate their own RINs to offset their own compliance. And with that, let's pop it back over to the feedstocks to look at how they'll be affected.
Okay. Thank you, Cusick. I appreciate that. Tori, can you go ahead and talk about veg oils for us?
Sure. So I'll start with soybean oil. This week, we've already gotten the monthly NOPA supply and demand report. There were some pretty big surprises in the report. Probably the smaller surprise in the data that was reported was the fact that the NOPA crush for January was a record 176.9 million bushels. That's up 5.3 million from last year and just over 2 million from last month. That was near the upper end of the range of analysts' expectations and above, well above the Jacobson's expectation for the report. Crush margins haven't been as strong as they were for a lot of last year, although certainly hog herds have ramped up in anticipation of exports to China, and so soybean meal demand, I think, is strong, although the pricing, the futures wouldn't suggest that it's really strong. But still, the crushers are crushing, and as a result, that leads to a lot of soybean oil supply. So soybean oil production was reported just over 2 billion pounds at 2.03 billion pounds, which was up from 2.01 billion last month and up from 1.99 billion last year. Soybean oil production wasn't a record in part because soybean oil yields this year, as we pointed out early in the year, as we started harvest, are significantly below where they were last year and near the lower end of the historical range. That's going to continue through the rest of the year, and so while crush may remain at record levels, soybean oil production certainly will be ample, but it won't be what it might have been if yields were certainly higher than they are turning out to be this year. By far the biggest surprise in the report was the NOPA soybean oil stocks estimate, which came in at a record 2.01, or not at a record, I apologize, just above 2 billion pounds. That was well above market expectations and well above our expectation, which was near the upper end of the range of market expectations. It was up 464 million pounds from last year and 256 million pounds from last month. Now, last month we had a kind of a similar situation, in where the NOPA oil stocks estimate came in above market expectations. And then USDA followed that up with a report that suggested the spread between the NOPA inventories and industry-wide inventories was near the upper end of the range of narrowness, meaning that NOPA stocks represented a larger percentage of the overall stocks than they typically do. We expect that probably continues this month. I'm not exactly sure why this shift in the last 2 months from sort of the lower end of the range to the upper end of the range, but it likely has something to do with the restart of the capacity in the biodiesel industry and where those stocks are stored as biomass-based diesel producers start to gear up. The key question then really becomes, where do you estimate U.S. soybean oil stocks, industry-wide soybean oil stocks? We picked 2.32 billion pounds, which is up about a little less than 300 million, or a little bit more than 200 million pounds from just over 2 billion pounds, 2.1 billion pounds last month. And that implies that domestic demand in January was 1.75 billion pounds, down from 1.89 in December, and sorry,
Pesky
1.89.
iPhones.
Yeah, sorry. I've also gone over my time. So down from 1.89, but still within the range of what we've seen. So despite the fact that we had a big upside surprise in NOPA soybean oil stocks, we don't expect that necessarily means that that domestic soybean oil demand has dropped off sharply. One other thing I'll just quickly cover is, in palm oil, we've seen some real pressure on palm oil prices. It's continuing the same themes that we've seen. People are worried about the coronavirus, and the political tensions with India mean that exports are falling off at the same time that production is recovering from the drought. It looks like production may be up as much as 40%, at least on a daily average basis this month, and so that's what's been pressuring palm oil. Okay, with that, I'll throw it back to George.
All right, thanks, Tori. Ryan, can you walk us through the low CI section of the report?
Yeah, so this week we focused on yellow grease and used cooking oil, which are increasingly becoming bifurcated markets. Used cooking oil, it's got a very finite supply and it's limited in the United States, around the world, and competition for it is really heating up. It works into a number of different low carbon schemes, California, Europe, and as a result, buyers in the US and abroad are really aggressively pursuing their supply. We've seen prices top out as high as 35 cents, maybe a little bit higher this week for sales of April delivery into the Gulf. We expect that number to continue to rise through the summer as competition heats up. East Coast demand, there's a lot of long positions on, so we haven't seen a tremendous amount of movement this week in that, but we expect those prices to increase in the near term as well. Big reason for that is the potential impact of the coronavirus on shipments out of China. There's some logistical complications, as well as, the holiday and people not eating out, not going out in public as much, tends to limit the supply of used cooking oil in the market. As far as yellow grease goes, we expect that market to continue to see support as stronger tallow prices as recent as yesterday are supporting an overall strong animal fat complex. As the saying goes, a rising tide lifts all boats. Strong tallow demand, strong choice white grease demand are pulling up yellow grease prices. And there's just not a lot of cheaper alternatives for buyers at the moment. With that said, if prices continue to rise, we could see some reformulations in the mid-March, April timeframe, as corn values are kind of stagnant at the moment. We could see feeders push more corn into rations. With that, George, I'll wrap up, and if you have any questions coming in, be happy to take those.
Okay. So we'll go back to the attendees. If you have any questions, go ahead and submit them in the Q&A section. From there, we'll go ahead and address them. Ryan, the first question that's coming in is a question I've had. What's the difference between UCO and yellow grease? Because I thought they were the same thing.
Yeah, that's a question we get a lot. Yellow grease is a catch-all term for max 15% free fatty acid to MIU, which is moisture insolubles and unsaponifiables, like it's an AOFOA spec. So anything that falls underneath those specs can be considered yellow grease. So it can be high acid tallow, choice white, a mix, and usually it's a mix of collected waste oil from restaurants, high acid animal fats, and that's blended into a product that traditionally went into the feed sector, but now with the demand for used cooking oil specifically, that's a separate product. So like I like to say, used cooking oil can be yellow grease, yet not all yellow grease can be used cooking oil.
All right, thanks for clarifying that. Cusick, this one's going over to you. RINs are on fire. Will they overheat sooner than you anticipate from past forecasts? And also, Where's the ceiling?
Yeah, I think it's tricky to say. We haven't seen the D4 RINs move yet, and often what happens in these sort of what I'll call sort of unconfirmed emotional moments for the RIN market, and I describe what's happening right now is there's a lot around the SREs and how people have been sort of defending their numbers on future SREs that suggest that the SREs may not be onerous moving forward. And so people are sort of thinking that more RINs are required. As the D6 trades at a much higher scale, sort of 9-to-1 to the D4, that's the one that tends to break away and lead the pack and is really shoot up. So it seems to already sort of be simmering a little bit, but it's made a significant move. The D4 has been a little bit more timid, right? And so the question right now is, does the D4 catch some of this emotional steam? It appears it may not, in which case we see the D6 maybe doing a little bit of an up-down. For right now, we see the D4 sort of weathering this, maybe not moving a step or two up as quickly as we thought in the coming week, but continually, constructively, we see it moving upwards across the coming weeks.
Okay. Thank you, John. Tori, we'll go over to you. What is the value of soybean oil in biodiesel production given the current price of biodiesel?
So there's actually a couple of different ways that you can kind of try and estimate this. If you look at biodiesel prices full up in the Midwest, like we quote, you get a number that's north of 40 cents right now. If you back the RIN values out, that knocks it down to like about 35 cents. If you just look at soybean oil compared to heating oil, which is one of the common things that we talk about in the report, the hobo spread, that implies that the soybean oil value is around 22 cents. Now, if you look at the difference between sort of the value of soybean oil and the value of the final product, which I would argue is sort of biodiesel with RINs, you can argue that that profit margin, for lack of a better way to sort of put it, fell down to below 7 cents and almost below 6 cents at the end of last year in December. It started to recover a little bit in January. It jumped back up almost to 7 cents. But in February here, we're back above 10 cents. And over the next couple of months, it stays at that 10, 11 cent level. So I think that in terms of like indicators of when the soybean oil demand from biomass-based diesel producers is going to come back, the market economic signals are starting to suggest that now is a good time for these guys to produce and that they should be able to make pretty good money at it right now.
Okay, thanks, Tori. And I think we have time here for one more question. Cusick, we'll send this one to you. The USDA had a forecast up to 2029, which really seems not to consider the potential fuel market demand emerging the way that Jacobson envisions that. Do you want to talk about that a little bit more?
I think so. What we're talking is USDA forecasts sort of flat soybean oil acreage versus what we're communicating, which is significant demand coming at the market from the fuel side, I think is probably what that question is. And I think it's important to understand the USDA's methodology, but also, a lot of these announcements initially, in this renewable diesel, these projects of renewable diesel and co-processing coming on, we expect that as those initial projects coming on, those projects are going to simply be taking feedstock and market share away from other processes and facilities in theory, right? Because the overall demand will still be capped by RFS. The question now being asked, and the one we're working on in things like the market intelligence report, is what if these LCFS programs like California, which has a 4 billion gallon diesel market, what if these LCFS programs start pulling feedstock demand beyond the federal RFS numbers tied to RINs of 2.5, 3 billion gallons? Those are the kind of questions, right? And the USDA isn't there today. So today they're applying a methodology of what the world looks like at this moment, not what it might look like. Tori, help me out here, but I think there's some methodology things you can add here. But the USDA needs to look at what is happening today as they forecast that report. What we're looking at and trying to answer to our subscribers is what it could look like in 10 years. And we're getting, you know, that information from BP and various other people as they begin to share what their plans are for a low carbon fuel market transformation. But Tori, maybe you could just touch on that too.
Sure. So you're exactly right. In the short term, what the USDA relies on, and what we all rely on, is sort of the EPA mandates that are published, and that's what they use for to forecast biofuel demand. In the longer term, their long-term projections model is really an econometrically driven model that certainly incorporates some assumptions about what's going to happen in the biofuel space and the demand that's going to be generated from that. But it's more economically driven than it is sort of boots on the ground driven. And I think one of the main differences in our forecast from the USDA's forecast and why we've been a little bit better at assuming the demand for stuff like soybean oil over the last couple of years has been the fact that people like John that work for the Jacobson are out talking to people in the industry every day, and we're able to translate what they're hearing in real granular detail into that demand model. And that helps us both in sort of our forecast for the next year, but it also helps us build a forecast out for the next 10 years. And so we have a list of all of these plant announcements that have been made, and we look at what we think the demand for those is going to be on a monthly basis going forward out for quite a while, and that's what we use. And so that's why there will be a difference in what we see and what the USDA is seeing. Not that one approach is necessarily right or one is necessarily wrong. What the USDA does is perfect for what they're trying to do, but things can always change. So our forecast can be more accurate or less accurate, but it's just sort of two different approaches right now.
Okay. Thorough explanation. Thank you, guys. That concludes the questions that we have this week. For those that are in attendance, thanks for the questions. And John, Tori, Ryan, thank you for taking the time to answer them. We'll post this as a webinar for everybody to watch later. And we welcome you to join us next week. We'll be back on Tuesday, not Wednesdays. We'll be back on Tuesday, 1 p.m. Eastern time. And we look forward to talking to you then. Have a great day.
Thanks, everybody.
Thanks, everybody.
Thank you.